liabilities to pension plans, or you're an endowment, or you're an institution, or you're just a high net worth or Joe Schmo retirement, you're looking for a way to deal with two things: the low yields in cash, the low yields in short, medium duration paper, and then you're dealing with where do you go in case inflation heats up.
And there's a clientele that's clearly going here.
Yeah. But I guess the point being that
they're not getting any return to be there.
Right. And would real estate be viewed more and more as an alternative? Would that suck more money into real estate?
Has been.
And is that a good thing or long term, or is that a bubble?
So we actually wrote a paper on real estate as an inflation hedge. And we've only had one big period of inflation in the U.S., and that was 78 to 82, double-digit inflation. When that period of time came, the office, apartment markets, all the markets were in equilibrium. That is, supply and demand were in equilibrium, vacancy rates were low. And so during that time period, it was a super inflation hedge. That's where the view that real estate's an inflation hedge comes from. And it worked in that time period. I'd say if inflation is under 4%, 4% or so, it doesn't really matter. But in the long run, real estate has to be an inflation hedge because we have to build it. And basically, construction costs have outpaced inflation by 1 or 1.5% a year, and land costs, as we become more densely populated, also go up faster than inflation. So there's fundamental reasons.
Yeah, you would acknowledge that over a 5-year time horizon or less, the supply-demand fundamentals trump this.
By far.
But would you say, if you're looking longer term, that it would make sense economically, that it would be
but you have to
keeping pace with?
Make sure you're in equilibrium, and make sure your lease structure allows basically rents to adjust. If you've got 20-year leases and we get a surge of inflation and they're fixed, you're in trouble.
So when we move over to pricing of our asset class, and this chart, Peter?
Yeah, what we do is just crudely take cash flow cap rates rather than NOI, because I'd much rather have cash flow than NOI. I've got recurring CapEx and leasing and so forth, right? So all we try to do is net it out as best we can for the categories. This goes back.
So this is sort of 68% of an office cap rate and 83% of a
That's
apartment.
right. You've got different numbers for each property category.
Right.
Okay,
Gotcha.
Based on NACREIF numbers.
Yeah.
You go back to 1980s.
This is not a broker cap rate.
No, this is not a broker.
Okay.
And the point is, you go.
Where's Roy March?
And you follow. There's been 3 times now the cap rates have been this low. In the early 80s, but in the early 80s you weren't buying real estate. You were buying tax losses. Mm-hmm. That's what you were really buying, the depreciation that was there. That disappeared and as soon as that disappeared, you start seeing cap rates go up.
87.
You get the other period was right before the recession begins. The capital market is lofty beyond belief, and you get the lowest cap rates. We're almost back down to those cash flow cap rates now. They're quite low. They're not as low. And in that sense, the capital that's come in has not flowed as much to real estate. There's still, it's flowed more in the last year or two, but we still haven't gotten as low as we were. Other thing you see here is, this is back of the envelope, if you will, but you see why multifamily is attractive. It's a higher cash flow. It may be a lower NOI, but in a cash flow, it's higher. And this chart then takes the same chart as you saw before and nets off 10-year Treasury. So you're looking at a spread. It's the same thing, only
That's a fascinating chart. So here we are with these artificially low 10 years, and we're looking the best over the entire time series.
And once you've got, obviously, a negative spread, if you're a seller, you'd love. That's the point. But you had that in the early 80s, but that's because you were selling tax losses. You weren't selling real estate. You were selling tax losses. We got down in the modern period, if you will, kind of these real low cap rates right before the recession set in. The interesting thing is today we've got low cap rates, but almost record high
Yeah, I'm
spreads.
having trouble figuring out, do I feel good about this
and
or not?
That's the dissonance. You've got exactly the dissonance.
I think you should feel very good about this relative to everything else. But remember, the distortion of the 10-year Treasury says when it changes, and it will change, the absolute cap rate may not go up a lot initially, but as we move up the curve, we have a nonlinear movement upward. The spread compacts first, but then eventually we do get the value destruction, I would say.
Well, interesting, I think, Ken, that the sector's been helped in pricing rationality in the way you're saying by the absence of CMBS until recently,
Yeah, but they're
which
back.
doesn't do the relative pricing, and by life companies putting on floors, and they're starting to disappear. But those two kept the debt side flowing kind of absolute rather than spread. That's starting to change.
Well, it occurs to me that if you have this fear of the rising Treasury, which I think all three of us say is something that the room should be anticipating, where none of us are saying when. Let's, before we leave this topic.
By the way, I'll say when.
Okay.
2.5 years ago. I've been wrong for 2.5 years, right?
So, okay, so 1 year from today, the Ides of March, 2014, the 10-year Treasury. Peter.
Don't fight the Fed. It's still going to be between 2 and 2.5. It should be, as Ken said, 5.5.
Okay, not a should be. I want your forecast. So 2.5.
Yeah.
Yeah. The way the majority of the
Just
Fed
don't
is.
fight the
Yeah,
don't
okay.
fight the Fed.
Anything different to offer, Ken?
Yes, I think we'll be at 3.25. They're already, the Fed, they announced this new massive purchase program, December, $85 billion a month net new purchases of mortgage-backed securities and treasuries. 10 years gone from 1.6 to 205. Ben Bernanke said last week, well, this is what he expected. No way he expected this.
No way.
And he expected he could repress rates. So repressed rates, I think the world is going to wake up and say, we're not going to take that. Now, we'll get part of the way there. So 3.25 is my best guess for March 15th next year, a year from now.
Yeah, it's certainly, looking at the forward yield curve, it's closer to what Ken is saying than what Peter's saying, but certainly when you read the Fed minutes and the 6.5%, Peter's right that the Fed is basically telling you it's going to do everything it can to keep it at in the twos. So, well, let's talk a little. We're in Washington, D.C. You can't help but want to take a few shots here. So, you know, it's an easy target, I know, but let's just talk a little bit about it in an economic sense, okay? So what does it mean for our cash flows? What does it mean for our U.S. economy? What does tax and fiscal policy, not just monetary policy, mean? Peter, what would you, is there a crowding out going on? What's
there's no doubt there's a crowding out that's going on. The private sector's had a lot of their activity dampened by the government picking up because you know you have a future tax liability. This chart goes back to 55, and it shows federal government revenues as a percent of GDP, federal government expenditures as a percent of GDP, and then the deficit, the gap between them. There's basically three phases. Prior to 74, the government basically spent and collected around 17% with a little skew to collecting a little less. We then decided we don't want senior citizens to be poor. We changed Social Security and Medicare. That put in about a 2.5% of GDP gap between what we collected and what we spent. We spent about 21% of GDP. We collected about 18.5%. During that time period, the argument in Washington was over 10 to 50 basis points. Namely, I want to raise taxes 10 to 50. I want to cut spending 10 to 50 basis points. And a 2.5% deficit is sustainable. Not good or bad, but sustainable if the economy is growing 2.5 to 3% a year. That's the math. What happened in the third phase is we went where instead of raising 18.5%, we were raising 14 to 16%. And we went from spending 21% to spending 24 to 25%. That got us double-digit deficits. That's not sustainable in an economy growing 2%. You can do it for a while. The argument is no longer over 10 to 50 basis points. The argument's over 300 to 400 basis points, and they haven't understood
Okay, I understand your logic. The disconnect I'm having is that there is plenty of money around. There is massive amounts of corporate earnings sitting on corporate balance sheets. There is ready access to the unsecured debt market for corporates. Is an active IPO and M&A market. Stock market is nominally on all-time high. There's all this liquidity and monetary base creation that we just talked about, the Fed printing money.
Money everywhere, but not if you're a risk-based entrepreneur, only if you have corporate credit and access to, quote, institutional
Ken, do you agree
capital.
with this?
So I actually think there isn't any crowding out right now. What I'm worried about is the fact that we have a structural deficit. So Peter combined the two. About half of this deficit is because of the economy being weak, and the other half really is structural. That in the long run, if we don't fix Medicare, Medicaid, Social Security, we are going to face either a massive tax increase or a substantial benefit cut. We need to face up the next 10 years, 15 years now. So the structural problem worries me more than the cyclical problem. Right now, doesn't really matter. And the fight shouldn't be over right now. 85 billion one way or the other doesn't matter. It's what's going to happen, the multi-trillion-dollar deficit that's going to come as our baby boomers retire. As we retire, there's too many of us who want the rest of you to pay for us. We really like that. We appreciate it.
The retirement of the boomers also takes out a lot of peak payers to Social Security withholding. So everybody focuses on us as a beneficiary. Its immediate impact is more as a contributor because we don't have so many illnesses as we are in the early phase. It does matter. People don't understand that roughly the deficit's about $1.1 trillion right now. If you said everything other than interest payments, Social Security, Medicare, and Medicaid is about $1.2 trillion. If you don't touch interest, Medicare, Medicaid, and Social Security, and you eliminated every dollar the government spends at the federal level, you basically just balance the budget. And that's before what Ken's saying.
I guess the question that keeps coming up is this deficit spending a drag on the economy or not? And we're reading Krugman shrilly pointing out week after week, this is the right thing to do. And you have a whole, the Ryan budget's clearly saying this is not the right thing for Americans to do. It's putting a burden on future generations. And what?
Look, there is no G. There is no government spending. And in fact, it's interesting that as the sequester hits, suddenly the Democrats are saying, well, not all G is the same. We've got to cut certain G because it's unproductive relative to the other. There is no such thing as G. It is money that's being spent. Is it being spent efficiently or inefficiently relative to alternative? If it's more efficient than the alternative, it's adding to the economy. If it's less efficient, it's detracting. You take your pick.
Yeah, the fiscal debates this week have just been whipsawing. The Ryan budget last week, and now the Senate Democrats coming up with a budget that just exactly hit on what you say. It's a debate over where America should be spending and on what. The Fed, just back to that, is meanwhile spending even more than in terms of an increase, even more than anybody. This is a picture just showing what the QE 1, 2, and infinity look like in aggregate. It's now up to a balance sheet of $3 trillion. They've bought all these MBSs. They've bought all the Operation Twist Treasuries to maneuver the interest rates down at the long end. And this is now another piece of the puzzle that in a C plus I plus G equation, I don't remember how we were supposed to think about this. Ken, how do you think about this?
I think what they're trying to do is hold down long interest rates, thinking it's going to stimulate single-family housing and investment, make the dollar weaker, and therefore make the economy and the stock market higher so people will spend more money. It is the wrong thing to do at this point. The purple, exactly right to do. But at this point, they're going to take this $3 trillion balance sheet and go to $4 trillion if they continue to buy. And in the end, it's just the wrong thing to do. We all live off that risk-free rate and spreads off that risk-free rate. If it's distorted so dramatically, it means the investment decisions we're making in this environment are going to come back to haunt us. So I think it's a mistake.
So another place where liquidity is showing up is the monetary base.
Yeah, I mean, this is essentially a variation of the chart Ken showed you, but this is the base money in the economy that the Fed creates, if you will, going way back. And it had a nice, smooth movement with minor growth right until it doubled in about 8 months. And now it's growing by another $1 trillion. There's been almost $2 trillion the Fed has pumped into the system through the mechanics that Ken was describing out of nothing. The reason we have an inflation so far is it's just been pumped into banks. And so they've recapitalized the banks, but the banks have not, until very recently, let the money come out. At some point, every belief says it'll come out. And when it comes out, it'll come out faster and in unpredictable ways, and hence the future on this that Ken and I are saying.
And just add one more thing. The Fed is definitely going to be dovish for some time here with the appointees you've got. So they're going to be late to the party, behind the curve. But when they finally get to do something, it's going to be bigger and faster than we expect.
The other thing, Ken, is on that, you said the QE1 was right, and I would say in general, yes. It didn't achieve what they thought it was going to achieve. They thought they would pump money in the system, and you would get a big multiplier effect of what banks would do in their lending. And in fact,
It was a bailout
they
to the
pumped
banks.
money in.
It helped the banks.
And in spite of the fact that banks did not lend, they said this is working, and did more of it and more of it.
Well,
Well,
Because they
I
could
think
pass
it
the stress
prevented. I
test.
think it prevented. We were in a financial. I remember very highly in 2008. We were in that fall in a financial collapse environment. So that I think that's the role of a central bank, lender of last resort, prevent the crisis, or at least try to ameliorate the crisis. They did that. In March in 2009 is when we started the stock market rally. So they did stop the financial crisis.
And they didn't fuel
But
the
they
housing
can't
market.
make the economy grow. The
No,
Fed
it was the
can't do
C.
that.
It was the C of
The
C.
housing market has
yeah.
come back exactly when supply and demand of housing
Agreed.
got into fundamentals, and all this other was smoke and mirrors. And it's are there more houses than there are people to live in them?
All right. Well, let's touch lightly on the rest of the world. There is a world beyond our borders. Jillian and David Rubenstein will plunge in even deeper, I feel sure, on the world. You have cards at your tables. We will take those cards with comments and questions. Just bring them on up. Amy and Gail will pick them up. We also have mics around. What we're going to do now, guys, is just briefly tour the world, quick walk around the world while the questions come in. It's fun to take a few from the mic and a few from the cards. So while that's happening, let's just talk a little bit about the new normal as it relates to the rest of the world. IMF data would suggest that a new normal for world GDP growth, not a number everybody's used to looking at, it looks like it's going to end up being around 4.25. Now, there's higher demographic growth in other parts of the world. It used to be around 5, so a 4.25 number is lower. But most of that increase is really coming from these emerging markets. And it's the rich world that has to slow for the reasons Ken said of demographics and just the natural thing that happens as an economy becomes a part of the $1 trillion club. It's going to be slowing down. Doesn't have to, but it certainly has been working that way over the course of decades. So this is the picture we're looking at. Ken, Peter, anything you'd comment on this? The emerging market piece of world growth is 60%.
So I want to do one place, 2 places. First, Western Europe. 17 countries have a single currency, but don't have integrated labor markets, capital markets, culture, or work ethic. It was bound not to work as a single currency. The Euro region works, just don't have a single currency. Till they decide to get rid of that, they're going to falter. Germany's going to be successful, and the rest won't. Then China. Roughly 50% of China's growth is this investment boom in residential real estate and infrastructure, overbuilding dramatically, and I think that's a major issue. So I think that the account of the rest of the world being a lot better than us, I think we're going to look pretty good by comparison.
This is a wide variety of different interest rates you see around the world, just to pick up on that diversity that you see with China and other countries at the high end, and Brazil, almost incredibly expensive credit for those of you working in Brazil.
Just on that one thing, Jacques, the statement about how distorted capital markets are is you'll read in the paper that Italy and Spain and Greece are paying outrageous amounts for their debt. Now remember, these are countries who've said, we're not really going to repay you. We've already told you that. We're not going to repay you, and yet...
Unless you lend us more, then we will.
Unless you lend us enough and you pay it. We're not going to repay you. Well said, Jacques. And yet you'll see their interest rates are 5 and 6%. 5 and 6%. A little higher in Greece. And these are people who have promised you they aren't going to repay you. That's a distorted market. They only look high because Canada and U.S. and Germany are so low. It's not, again, it just underscores the distortion degree.
And this is the trade imbalance I was talking about.
Okay, yep.
Germany, huge trade surplus since the euro started in 1999. You can see bigger and bigger. And the peripheral countries, huge deficits. That's the problem. Italy and Spain, Greece always devalued their currency nice and slowly over time so they could remain
They need
competitive.
to federalize. That's West Virginia down there.
That's
West Virginia.
Well, the other thing, too, that you see when you're around Europe is, the Germans are doing great. The restaurants are full, the hotels are full, the Autobahn has new cars on it. And when you go to Spain, and now even in France, there is a real sense of despair. This is the youth unemployment rates, and they're in the streets. They're out there with their placards. It's a very scary feeling.
Germany is a far more socialist place than the U.S., but they made some very important fundamental changes to their labor laws, their product laws, and their competitiveness about 12 years ago, almost as the euro was being instituted. And their productivity is up some 30%, particularly because they changed laws allowing more temporary workers to be used.
I think we have a slide on that productivity. The German productivity
I think you have
engine
on
is
cost,
amazing.
but and at the same time, Greece and Spain did not increase their productivity, but their labor costs went up. So Germany's labor costs went up the least of all these countries. Their productivity went up enormously from already being more productive.
Well, this is a little, these slides are weird. I mean, Spain is at the top of the change in labor cost chart that you gave me, Ken.
Right.
And it's also at the top of the youth unemployment. What is the story with this?
That's why.
Exactly.
Their costs have gone up. Their labor market is very inflexible. If you've got a job, you keep it, especially if you work for the government and you get higher wages.
Well, that is the problem. I know the labor law in France. I know that's the story. You're reluctant to hire because you can never fire. You cannot. You have to fill out so much paperwork to fire a person over 3 years. And you have to put all kinds of stuff into the government in order to do that. I imagine
and the youth bear that, and the less educated youth bear it even
I'm
more.
just saying that whether it was the last government that put Hollande in, or in Spain and Italy, the recent elections we had there is an awful lot of political noise around the despair, which is it's the austerity backlash, right? And it's just, you see it when you're there.
It's the backlash, and so I think Europe with a single currency is not sustainable in terms of getting strong economic growth, solving this problem. And there's only one solution. Another solution they could have, they could let the euro drop, like the Japanese yen. It's dropped from 132 to 104 in 8 weeks. Japan is going to recover. It's going to help. It's a currency war. The euro should go to 1 from 130.
Absolutely. But the euro shouldn't exist.
The euro should disappear.
Exist. I mean, you can't, it's a fixed, all it is a fixed exchange rate system. And those of you who are old enough know that fixed exchange rate systems eventually have broken. And the euro is nothing more than a fixed exchange rate system. That's all it is.
Well, the distressed guys in the audience are licking their chops at what you're describing. So there's certainly...
The risk they run is, do you fight the government? You know what will happen, a la Ken's comment about interest. But you could go broke fighting these governments.
And Ken, you did mention the bubble in China, which 60 Minutes did a brilliant job of bringing to our TV sets a couple of weeks ago. These are the official government statistics showing that the prices are holding up, and basically you have even higher doubling and tripling of prices in cities like Beijing and Shanghai. This is 18 cities, so it's a little harder to see. If you didn't see the 60 Minutes episode, you might want to go look it up. It's pretty funny. It's pretty amazing. It's about the ghost towns. But as you mentioned in China, you're worried about it. But when you go to China, you certainly note that the ghost towns are a lot of what we did with the S&Ls, building crazy real estate, poorly planned, poorly executed in places that nobody wants it, for ultra-rich people that are buying them just for an investment, not to occupy. So it reminds me of what happened when the S&Ls started building.
That ended well.
Yeah, it did. And
that ended well for us, so it will end the same way for them.
Well, I think China has much more control over their economy, at least ostensibly, but they actually don't. They can't control the real estate sector. Supposedly they control lending, but they really haven't been able to. So they're trying to put in controls now. And prices have fallen, actually, over the last year and a half. That 60-minute story should have been run 2 years ago. It's 2 years after the fact. Market's recovering a little bit, but the bottom line is you can't buy 5, 10, 15 apartments, which a lot of people have done. So now you can only buy 2. They don't have as much leverage in the system.
But if you get divorced, you can buy 4.
And you're laughing, Peter, but there was
No,
actually
I don't.
a newspaper article about people doing that so they could participate in the market.
And you can't flip it, and you can't borrow more than like 50% now. There's just a lot of ways that
China's
and it's metro by metro. There are different rules in different provinces.
It's the Wild West in terms of the high-end housing market.
All right, so we have so many cards coming in, and I would say that the number one thing that is coming in is a bit about this chart, which is the capital flows, and that it seems to be a theme about, okay, guys, I get the idea that interest rates have to rise, and that if your forecast of 3.25 comes to play, or even a 5% 10-year, well, then what happens to real estate pricing, and what happens to the capital flows to real estate? That's the primary gist of about half of these.
I think Ken got it when we were talking about the spread. It differs on each property and each market. The bigger the spread is today relative to historic, if you will, the more cushion you've got against the first couple 100 basis points movement in long rates. And if it's New York apartments, you've got less cushion. New York A apartments, you've got less cushion than if it's Des Moines warehouse, where the spread is still really big. Because I think Ken hit it. The first is going to be absorbed mostly. It's already priced in, but not everywhere.
Well, I mean, one of the questions is, can you help me understand where I should be moving by property type if inflation and interest rates move up? And you're kind of getting at some ideas there. An idea I would share is we had back in that time period you talked about, it was very common to have a CPI clause in a lease.
Yeah.
Correct.
It was usually a partial CPI protection, not full. But in Australia, in the UK, in France, in Mexico, in many, many countries, there's full indexation. France has it as well. Now it'd be great if landlords could put in full indexation. Maybe the market won't let us.
They can, but you've got to give something else on the other side. So if you want insurance, you got to pay something for it.
Right?
I do think so.
Any thoughts on that? I mean, you could also go short duration. So multifamily would be your best inflation and interest rate hedge, wouldn't it?
Yeah, so the really question is, when we get these higher interest rates, does that mean we have a very strong economy?
Yeah.
And will NII grow fast enough to outpace that cap rate increase?
It's a race.
And so it's a $1 trillion race for everyone in the room. Apartments, you can hear this afternoon what our experts think, but they certainly have the shortest lease structure, but they also have the lowest cap rates. Now, Peter's cash flow cap rates are very important. If you use the cash flow cap rates, apartments don't have the lowest cap rate. They're actually above everyone else. So you have to look at supply and demand dynamics. I think the CPI idea is very good, but you can't get it in markets that aren't tight. If markets are loose, there's so much negotiation. In San Francisco, we have the hottest office market in the country. You can get that now. So it just depends where you are.
The best hedge right now, I think, and it's been for a couple of years, is if what you want is around an 8 for your portfolio, go buy all cash, any apartment complex you find in Middle America at a 6 or north cap rate. Go spend the year
6? Where are you finding that?
In
Toledo.
Des Moines and Toledo. They're not going to disappear. They're going to be there. Those places you fly over are not going to disappear. They may not grow,
you might
but
not find anyone to sell it to.
But by the way, if I can put on a 40-year HUD, and I'll screw